Hi, this is Bo Yoder from 5MinuteInvestor.com. Taking a look at the Australian dollar, we can see one of our recent newsletter trades from the Forex trading newsletter available at 5MinuteInvestor.com. The Australian dollar has been trading within the context of a nice uptrend for some period of time, basing for a couple days right around 8100 before breaking out to a new high. Now, as many of you know from trading stocks and futures, the first pullback after a stock or a futures breaks out to an important new high is often the richest in terms of its pullback potential. Well, very much the same is true in the Forex markets, and that's what we were targeting in this newsletter trade. The market pulled back towards areas of support, identified one of those areas of support, and targeted an entry right around 8120. So you can see we pretty much got the low tick of this particular pullback. Saw 4 to 5 hours of upside as the market rallied, and then an enormous 1 to 2 bar volatility event. I zoom forward here, that came down, took out most of the stops that anyone would have had from this pullback, and then now the market has rallied right back up into our original direction and has actually moved up above our break-even by quite a little bit. So in this kind of a rip-off scenario, it's always good to go back and grade your trade. This is something that I do a lot with my consulting clients in my one-on-one consulting practice. They come to me with difficulties in their trading model. We begin to analyze their trades and try to figure out whether they're losing because of either a bad trading plan, no trading plan, or perhaps some errors in trade management. Because if a trade is a good trade in the beginning but just has a bad outcome and was managed correctly, there's really nothing to be gained from being frustrated. Obviously, the ego will always remember the trades like this, which whipsawed you out and then ran back up in the direction of original intent. But it conveniently forgets all the times when a stop loss is taken and the market just continues to fall out of bed afterwards, and you've protected yourself from significant loss. We always look, when we're trying to grade a trade, at what the original trade's opinion was. In this case, it was a long based on a pullback to areas of support. So we asked then, did the support manifest itself? Well, yes, it did. 4 hours of steady rally out of the entry, very precise, clean entry, very small amount of risk was taken on the trade. So we did our job as professional traders first to control our risk and then worry about profits later. We saw some fairly decent upside. The market was just starting to accelerate, and then in 2 hours we saw a large volatility spike that actually moved almost as much as the entire previous day's trading. So that's an anomalous event. The market did not grind down to take out stops. It spiked. So that's another thing that you can't really predict, and therefore is a positive for the trade. And then the fact that the market moved right back up in the original direction shows that the line of least resistance that we picked was correct. So this was a good trade with a bad outcome. A good trade, a good entry, a good stop loss level, and there really is nothing that needs to be done to the overall trading plan in order to adjust for this loss. It's just an unfortunate incident, and it's one to be taken in stride. For those of you who play cards, this is very much the situation you have when you've been waiting patiently and playing poker correctly until you get a pair of faces in your hand, which is the best possible starting hand. Has something like an 80% win rate when taken heads up, I believe. But yet you play that hand, you play it correctly, you have the luck factor it takes in order to get those cards, and yet you still lose. And that's exactly what we had here. We had the patience to wait for the trade, the discipline to enter it in a proper manner with very small risk for potential reward. And unfortunately, this time the aces got cracked, and so we take that in stride and move on. The thing that's so important about these sorts of trades is not to let the very natural frustration and anger that they bring up because of the loss that they produced for what seems like a meaningless move. Do not let that anger spill over into the next trade. This is something I see again and again in my consulting clients, what I call revenge trading. Having seen this sort of a whipsaw, as soon as the market zooms back up towards the area where they entered previously, they'll get long. Let's say they get long right around 81.30. So they actually get a fill that's worse off than their original one. Well, now where in the world are you going to put your stop? Well, technically you should put it all the way back down here at the lows. So the risk reward is going to be just disgusting and terrible for your overall profitability. So often, because they can't justify that large risk, they'll either put an arbitrary stop in or use no stop at all, which is even worse. Well, now let's think about this from a logical perspective. The market's been in an uptrend. It came back to an area of very strong chart support and reversed very cleanly. So why didn't it rally? Well, obviously there's an area of overwhelming supply that we didn't know about or couldn't have predicted. It broke down, pretty much destroyed all the support levels, thus dampening the ardor of the bulls, and now it's rallying back up. So who's left here to buy? Most of the folks who were going to buy would have done so on the technical stimulus of this pullback. And then having taken a loss, they're probably not all that interested in getting back in, except the weekly disciplined ones as a revenge trade. So this actually has great potential to be a lower high. So what will happen is people will compound their trading error. They take a correct trade, a trade that should have provided them a nice profit. They take a small loss because of their disciplined entry, and then they take a much larger loss when they re-enter emotionally with no plan and end up buying into what's very likely to be a lower high and a more significant trend move to the downside. So the ones who set an arbitrary stop take the double loss and are even more angry and frustrated, even more likely to take emotionally based entries and make more trading errors, compounding the original error. But for those who did not have the stop set and are essentially suicidal by not controlling their risk, are going to see, very likely, a lower high and a much larger trend move, and they tend to take very catastrophic losses. I go back and I look at my clients, which now numbers probably into the hundreds. I can remember 2 or 3 distinct examples of people who took large disaster-type losses on their first entry. Every single other one that's come to me with a serious disaster on the books, and I'm talking maybe 30 to 50% of their account lost on one uncontrolled losing trade. It always happened as a revenge trade. It was always a secondary or even a third entry after a series of frustrations where they allowed their emotions to build until eventually they essentially reached a crisis of fear and became paralyzed as the market moved against them. Had no plan, had no ability or discipline to execute a stop loss, and ended up getting seriously damaged financially as a result. So grade your trades, take a look at them, decide whether you believe that the loss is due to an error in your management or an adjustment needed in your trading plan. If the answer is no to both questions, then pass that trade off as a good trade with a bad outcome. Don't worry about it and move on for the next edge. If you are trading with a positive risk-reward expectancy model, as I advocate, then the next trade is likely to wipe out 2 or 3 of your previous losers, so it's really not something to be concerned about. The only thing you can be concerned about is if you allow an initial trade to compound itself and provoke additional loss to your overall trading capital. So there you have it, a little lesson, hopefully help you grade your trades in the future. And as always, if you're interested in either the consulting or the Forex trading newsletter itself, please email me at info at 5minuteinvestor.com or visit the website for more information. As always, thanks for listening. My name's Bo Yoder. Good luck and good trading.